As of the market close on June 11, 2026 at 4 p.m. Eastern Time, Plug Power Inc. sits at a stock price of $2.83, marking a modest intraday decline of 1.05% from its opening price of $2.85, navigating an active trading day that saw the stock oscillate between a high of $2.88 and a low of $2.74. While a daily swing of a few pennies might seem like quiet noise for a stock notorious for massive historical volatility, what the public ticker does not tell you is that institutional traders are treating this sub-$3 zone as a battlefield. Over 46 million shares moved in this single session alone, signaling that major funds are actively repositioning themselves around this balance sheet. The general consensus among retail traders right now is that Plug Power is merely a hyper-speculative lottery ticket that moves strictly on broad clean energy sentiment, waiting around for a massive government backstop. The deeper operational reality, however, is that the company is quietly pulling engineering levers to fundamentally alter its commercial architecture, aggressively shifting its focus from massive capital-intensive infrastructure builds to high-margin, immediate deployment product lines. The market expectation for this company has long been anchored in a boom or bust cycle, where investors assume that every single quarter will bring another dilutive share offering or a looming cash crunch. But when you look at the actual numbers shaping the current landscape, the gap between what people expect and what is happening on the ground is widening. The broader narrative tells you that the stock has faced intense near-term pressure, pulling back significantly from its recent peaks above $4 established earlier in the year. Yet when you zoom out to a 12-month horizon, the equity has actually climbed over 120%, vastly outperforming the broader industrial average and leaving many short sellers caught in a structural squeeze. This massive variance between the short-term price bruising and the long-term upward trajectory is precisely where the smart crowd is looking for clues, weighing the persistent structural headwinds against undeniable commercial acceleration. Recent trading volumes reflect an intense tug-of-war between short-term momentum traders utilizing a retail Robinhood trading platform and sophisticated institutions managing risk through dedicated platforms like Interactive Brokers stock trading. The volatility we are witnessing is not just random retail speculation, it is driven by an underlying friction between a persistent negative 13% gross margin and an exploding product pipeline. Just days ago, the company announced a strategic move to stabilize its balance sheet by closing the sale of a federal investment tax credit associated with its Louisiana production facility, bringing in nearly $40 million in immediate non-dilutive liquidity. This follows a similar multi-million-dollar asset monetization earlier in the year, proving that management is finally listening to the market's demands for capital discipline. For anyone managing an individual brokerage account or structuring a long-term portfolio through Schwab Intelligent Portfolios, these actions represent a critical pivot from reckless spending to aggressive cash preservation. The core tension in this investment thesis lies entirely within the company's financial statements, where impressive top-line growth is constantly battling significant operating cash outflows. In the most recent first-quarter earnings report, revenues surprised Wall Street by climbing more than 22% year-over-year to surpass $163 million, soundly beating consensus estimates. The explosive engine behind this growth was the company's electrolyzer product division, which witnessed a staggering revenue surge of roughly 345% compared to the same period last year. This unprecedented demand highlights a massive corporate appetite for green hydrogen infrastructure across the globe, particularly through large-scale deployments like their proprietary PEM electrolyzers. Organizations are realizing that backup power needs are shifting, and clean energy alternatives are becoming an operational necessity rather than a public relations goal. Yet despite this massive revenue engine, the reality of a $150 million cash outflow during the single quarter keeps conservative analysts completely on the sidelines. Wall Street institutions analyzing the company through advanced institutional accounts look at the current cash balance of just over $223 million and immediately calculate the runway, wondering how long the business can survive without returning to the public markets for more equity capital. This structural anxiety explains why major asset managers looking to individual stocks alongside traditional holdings like an Apple stock or a massive market leader like Nvidia stock remain highly fragmented on this name. The consensus target from analysts still hovers around the $3 mark, indicating that the market is waiting for empirical proof of margin stabilization before committing to a full-scale re-rating. Let us pause for a second to gauge where the community stands on this asset class. Comment below how many shares of Plug Power you currently hold in your portfolio, and whether you are buying this recent dip or waiting for clearer signs of positive net cash flow. It is highly valuable to see how retail sentiment aligns with the institutional flow on these highly debated industrial names. To understand how the company arrived at this critical juncture, it is essential to analyze its broader business model and historical commercial footings. Founded decades ago, the business initially established its footprint by providing fuel cell systems to replace traditional lead-acid batteries in electric lift trucks used within high-volume warehouses. This material handling business allowed the company to secure massive blue-chip customers like Walmart and Amazon, who built entire distribution networks around the fast refueling capabilities of hydrogen technology. Over time, the corporate strategy expanded from simply manufacturing fuel cells to build an entire end-to-end green hydrogen ecosystem, which encompasses production, generation, liquefaction, storage, and transport infrastructure. This ambitious expansion required billions of dollars in capital expenditure, leading to a long history of accumulated deficits and substantial share dilution that historical investors remember all too well. When you track the historical performance over a 5-year window, the equity has suffered massive erosions, tumbling over 90% from its historical all-time highs, when the valuation was driven entirely by speculative euphoria rather than cold, hard financial realities. However, the legacy architecture built during that massive spending phase is exactly what is driving the current revenue surge. The company now has more than 320 megawatts of deployed electrolyzer capacity globally and boasts an active project pipeline valued at over $8 billion, giving it an industrial footprint that smaller clean energy competitors can simply not match. Looking ahead, the investment narrative will be determined whether the company can successfully execute its internal restructuring strategy, internally dubbed Project Quantum Leap. This initiative is designed specifically to optimize the distribution network, slash redundant labor costs, implement strict pricing actions, and significantly lower the cash burn rate. The chief financial officer recently noted that the second half of the year should yield even stronger margin improvements as their domestic green hydrogen production facilities continue to scale up to full capacity, reducing the company's reliance on expensive third-party hydrogen purchases that historically crush their fuel delivery margins. The macro tailwinds are also shifting in a way that could favor long-term infrastructure plays. With the rapid expansion of artificial intelligence data centers, technology giants are scouring the market for massive, reliable, zero-carbon backup power solutions. If the company can successfully position its large-scale stationary fuel cells as the primary backup mechanism for these power-hungry data hubs, it opens up a massive commercial channel completely independent of its traditional material handling business. This prospect has caused a quiet accumulation of the stock across various specialized green energy funds, with retail investors tracking these movements across modern investing sites and digital applications. For individuals structuring their portfolios using diversified vehicles like Fidelity Investments, evaluating a highly volatile asset like this requires balancing pure growth speculation against fundamental balance sheet risk. Many long-term investors prefer to gain exposure to this sector through diversified Fidelity ETFs or broader Fidelity mutual funds to avoid the single stock risk of a company still working its way toward profitability. Those utilizing a standard Fidelity brokerage or a comprehensive Fidelity wealth management plan often treat green hydrogen as a minor satellite allocation within a broader, more conservative retirement structure like traditional or Roth Fidelity IRAs. Navigating these volatile positions has become significantly easier through modern execution tools, whether someone is monitoring market depth via the Fidelity mobile app or executing complex options hedges on a dedicated Fidelity trading platform. Ultimately, the future valuation of this equity rests on a very simple expectation versus reality equation. The market currently expects the company to struggle with liquidity and potentially dilute shareholders once again before the year concludes. If the reality matches this bleak outlook, the stock will likely test its previous 52-week lows and remain a distressed industrial asset. However, if the operational reality over the next 2 quarters demonstrates that the cost-cutting measures are working, that gross margins are ticking into positive territory, and that asset monetization strategies can sustain operations without massive equity dilution, the stock is poised to completely catch the market off guard. When a heavily shorted, deeply misunderstood asset begins to beat structural expectations, the upward re-rating can be swift and severe. To wrap things up cleanly, Plug Power represents a classic study in market friction, where massive commercial demand is constantly overshadowed by severe financial constraints. The company has proven that it can build world-class green hydrogen infrastructure and secure an enviable multi-billion-dollar project pipeline, but it has yet to prove it can do so while generating consistent cash inflows for its shareholders. Whether you view the stock as a distressed asset bound by its structural margins or a mispriced industrial leader on the verge of a historical operational turnaround depends entirely on how you weigh their current liquidity initiatives against their massive top-line growth. As the market continues to process the data, keeping a close eye on volume trends and cash burn metrics will remain the definitive guide for navigating this high-stakes clean energy play. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.